Hey guys, Nathan here. Today we're just kind of going to go through the first of the slideshows. We're going to go into just the intro into trading and financial markets. Um, just give everyone an insight just into what the financial markets are, what the different types of markets are, how the market moves. Just yeah, the overall basics of what trading is, what a chart is, what a trend is. Yeah, just overall basics. Nothing too complex today. So it should be decently quick, but it's just going to give an insight into what trading is and how people profit in the markets and make money through trading. So, yeah, from that we'll start. So, what is financial trading? It's pretty much the buying and selling of different financial instruments. So, whether that's shares, indices, forex, or commodities, um, it's pretty much people buying things low and selling things high, to put it simply. So the different types of categories that people do buy and sell within the different markets are shares. So that's just a small ownership, small units of ownership within a company. So that's your companies like Apple, Google, Tesla, YouTube, any foreign exchange listed company. No, any ASX listed company that would be for Australia. You guys can jump on and trade. There's also indices. So indices is a group of company that represent just a single number. So this would be maybe for the S&P 500. That would be the top 500 companies in the US. So that just gives an average amount that all the companies are performing at, and yeah, it gives people an overview of how the market's trending depending on the top 500 companies. So then there's also Forex. That's the one I mainly trade just because it's so liquid and it's open 24/7 except for the weekends. Also not 24/7, 24 hours a day, but not during the weekends. And there's commodities as well. So any physical asset, any raw materials, agricultural products, so just gold, wheat, silver, oil, things like that. So that's just taking advantage of the price changes in those, and same type of deal, buying and selling. So yeah, people slash companies, they often trade the financial instruments because they need assets for themselves or their businesses. So just for example, converting euros to dollars, you would participate in the Forex market. So it's just the conversion of one currency to the next. Most of the time, financial trades don't need assets at all. They simply are looking to profit from the movements in price. So initially buying low, selling high, or you sell at the top and ride the trend down. Yeah, so you don't physically need to own anything. Um, Everything's pretty much on TradingView. You look at your charts on TradingView, and wherever you're trading, whoever's your broker. Personally, I use MetaTrader 4 and TradingView. My broker's, oh, I can't remember off the top of my head at the moment, but yeah, they'll give you the different spreads and things like that. Your broker will be able to do different commissions and different spreads and just different types of deals. So do look around for the best broker. Mine's 8cap. I've just remembered off the top of my head. But yeah, you're pretty much looking for differences in price and following a directional bias to make a profit. So whether it's up or down, you're following that bias to make money off the different movements in price. So initially, this is what your chart would look like. I've changed my colors to orange and yellow just because it orange and green, sorry, just because it makes it a bit easier to not get in your head as much when things are going down and things aren't going in your favor. It just helps with the psychological aspect of everything. So just here, just a few basics. Up here, you have your time frames. You can go from anywhere from the 1 minute to the daily, to the weekly, to the monthly. It ranges from 1 minute, 5 minute, 10-minute, 15-minute, 1 hour, 4 hour, 1 hour, 2 hour, 4 hour. I think that's most of them. On your side, you've got all the prices of where it's moving and just historical prices. On this side here, I've got just the different currencies that I like to look at and like to just do analysis on. Up here is the currency that you're using or you're on. Right here is, again, just the time frame. And yeah, I've just got a few things plotted on the graphs, and these different colors are just the trading sessions. So the yellow is the London session, and the red is the New York session, and the yellow is just the overlap of it all. So how the market moves, the market wants to stay in a state of equilibrium all the time. So this pretty much means that every single candle is the average of buyers and sellers competing on price. So a chart is essentially psychology on a chart. It's thousands of decisions all at once. Some people think the chart's going to go up. Some people think the chart's going to go down. And then that's just, each candle is the average price of people that thought it was, in this case, going to go down and just keep going down. Institutions and corporations by law must maintain this balance. So essentially you're competing against these types of people because they'll try their best to, because they've got all the money within the market, they'll try their best to try and stop people out and just try and manipulate it at points. It's not quite fair, but life's not fair, but they'll manipulate it at points to take people's money. You don't make money, you take money. All the money is already within circulation. So essentially, we are competing against other people to take their money, essentially. So we want to be better than everyone else. It's a battle of buyers and sellers. So like I said before, supply and demand, it's people thinking that the price is either going to go up or down. That's all it is. And that dictates the movement in price, whether it goes up or whether it goes down. So psychology on a chart. When price gets low, people enter the market because they feel like they're getting a discount or a good deal. So currently at the moment, the date's the 3rd of the 11th. We're currently in a recession. So at the moment would be probably one of the best times to start buying assets because everything is at a discount, just for example. And when price is high, people want to sell and take their profits. So people they want their money. They want to take their money out of the market. Go spend it on their new Lambo or whatever. So why trade? For me personally, I wanted to get into the markets because I like the whole idea of the freedom, freedom of travel, freedom of financials, freedom just of time, just to get out of the 9-to-5 grind and just wanting a better life kind of thing. If I want to go to Thailand tomorrow and just hang out and do whatever, I've got the freedom to do that, and I can always I've got a way of making money from wherever I go in the world. Trading financial markets is all about balancing risk with potential reward. So picking assets likely to move in favor for a profit. So this is done sensibly and intelligently. If this is done sensibly and intelligently, the rewards can be a lot greater than the money sitting in the bank or working a full-time soulless job. Like I was saying, personally, I don't see myself doing that 9-to-5 grind. I personally see myself wanting to be free and just doing the things I love, doing the things I care about, spending my time on this earth making a positive impact. Pretty much. So what's Forex? So like I said before, I pretty much only trade Forex. At the moment, I'm looking at different other different other places to trade as well, like cryptos and stocks even. But yeah, just at the moment, just because it's so liquid, it's open 24 hours a day. And it's just easy to trade and get into. Forex is fantastic for all of that. So Forex is, it pretty much means the foreign exchange market. It's global currencies, so it's just a comparison of different global currencies. So, for example, GBP USD, so that's Great British Pound equals to whatever the price is at the time to one United States or to United States dollar. Yeah, so like I said, it's open 24 hours a day, Monday to Friday. It's the most liquid market. It does move quite quickly, which is good as well to get good price movements in the directions that you are trying to get. Yeah, and traders, they just take advantage of differences in price. So buy and sell movements in price. So if they think it's going to go up, they buy, obviously. If they think it's going to go down, they sell. So this is a big one. Psychology of the markets. Pretty much psychology makes up 80% of trading. So technical analysis. It's easy to get into, but hard to master. Once you kind of do master how the market behaves and how it moves, rather than filling your charts up with 1,001 different indicators, then it's all just a head game. It's you mastering your own emotions and pretty much just not getting full on negative when you do lose a trade. That's a massive thing. Not getting FOMO, risk management and your money management, and just, yeah, handling your own thought processes when you are in the market. So most people get over this by having a set of rules, a trading plan, an edge where they can just sit and stick to, a set of rules where they have the self-discipline enough that they don't deviate from those rules. So you must function at a probabilistic perspective. So trading is probabilities. No one knows where the market's going to go, if it's going to go up or whether or not it's going to go down. People are pretty much using different indications that the market's going to move in their favor. So the higher the probability that, the more indications that they get, the higher the probability that the market's going to move within their favor. So just for an example of the psychology side of it, to be good at trading, you're going to have to be able to lose without feeling like a loser. Losing, it's just got the negative psychological emotions associated with it. And you're going to have to be able to be wrong without the thinking there's anything wrong with you. So wrong, again, negative energy. You can be wrong, but you can still win. Just for example, if you set up a trade, you lose 2, but you've got a strategy where you've got a 1-to-3 risk-reward ratio. All it takes is one good trade, you're in profit. So you've got to get your mind right, rather than you lose 2, you let that go, it's no sweat off your back, then your next trade is the profitable one. What you're going to do is going to be a function of what you believe. I solemnly believe this is not just meant for trading, but also life. With trading, if you think the market's going to go up, you're going to function in a way where you jump into the market looking for buyers. Same thing. You believe something, the chances are you're going to pursue that and follow whatever your own belief is. Collective behavior patterns. Everyone that submits an order contributes to these patterns. The patterns repeat themselves. Is a statistic reliability, but the outcomes of the patterns are however random. So yeah, there are all these indicators like double tops, head and shoulders, falling wedges, rising flags, all those types of things. They're indicators of, I guess, market moving within the directional bias that you're choosing or a reversal. But of course, they don't play out like textbooks, like a textbook 100% of the time. Like 60% they might work, but it's your other analysis that will give you that bias that they're correct signals and that they're going to keep going within your favor. So we're just touching on everything today. The types of analysis, so there's both technical and fundamental analysis. Technical is trading based on the market action and market behavior. So you're pretty much sitting back looking at charts. You're sitting back looking at charts, pretty much. You're plotting points of interest on a chart where you think price is going to move. Where fundamental, you're watching the news, you're deciding whether a company has bearish or bullish tendencies. By the way, bullish means it's going to go up. If you're bullish on something, then that means you think that the price is going to move up. If it's bearish, look at it like a bear kind of clawing down. Bullish, horns up. That's the way I remember it. But it's based on any social, economic, or political forces. So, just for example, Tesla, I'm pretty sure when they announced that they were stopping Bitcoin or something, their stock price fell because obviously that's bearish news. People want Bitcoin, it's trending, it's new, it's exciting. And this just wasn't positive news for them, but then they ended up coming back and doing that ages later. So there's different types of trading. There's scalping, which is the in and out, very fast types of trades. You're holding trades for maybe minutes or hours at most. Your chart intervals will probably be the 1 minute, the 5 minute, the 15 minute. Then there's intraday. You could be holding a trade all day, but intraday pretty much means that you're not going to be holding trades overnight. So you'll be looking at the 15, the 1 hour, the 4 hour. Swing trading could be days, could be hours, could be even weeks. I think weeks is a bit of a stretch, but some people do. It's looking at the 1 hour, the 4 hour, and the daily. Obviously, the further down the time frame that you do go, the easier it is to make moves. So scalping, very fast. Imagine this as hard, medium, easy, easiest type of thing. Personally, I don't like holding trades overnight just because I like to see where the money's flowing and where everything's going, but each to their own. Different strategies call for different styles of trading. Each person's going to be different. Depending on what you're comfortable with, what you enjoy, how you like to trade. Depending on the person, it's going to be a different strategy. Personally, I like scalping and intraday trading. Like I said, I don't like keeping trades overnight. It's just what I'm comfortable with, and it's what my risk adversity just allows for. And there's position holding, so that's months or years. So that's your basic investment. But with the skill of trading, you can pretty much pick your point where you think it's going to be a good entry point, and then just sit and hold it for months. Once it gets to the peak or a level that you're interested in, take your profits and happy days kind of thing. So like I said, the institutions and corporations are the ones that we're competing against within the industry. These are just some of the people: commercial banks, hedge funds, real money, retail traders. That's what we are: sovereign wealth funds, prime brokers, retail brokers, proprietary trading firms, money transfer and remittance companies, foreign exchange fixing, commercial properties, governments, and central banks. So you don't really need to know this type of thing, but it doesn't hurt to know. You don't make money, you take money. So these are the people you want to be trying to be winning against, essentially. So now we'll just go into the candlestick basics. So what you have to remember with each candlestick, I'll get up a chart very quickly. So each candlestick, that represents whichever time frame you're on. So whether it's the 1 minute, the 5 minute, 3 minute, the hourly, the daily, the monthly, each candlestick will represent that one time frame that you are looking at. So we'll just jump on that chart once again. So right here I am on the hourly. So each candlestick represents an hour. But if you move down in the time frames, it pretty much, I'll go to the half an hour, so that will give me 2 candlesticks per hour, I guess. Move down to the 5 minute, and it just gives you a better overall view of what is actually happening within the markets. So it gives you a tighter view, but more zoomed in. So it's more, I guess you can do more analysis within that smaller area. So normally you go from the 1 hour down, or the 4 hour down, or the daily down, just to get an overall look at what the trend is doing, what the actual market is doing, and then make decisions based on that, and then moving your time frames down. So each candle, for a bullish candle, it will open at the bottom and it will close at the top. The wick, that's essentially the high. So the candle pushed all the way up to here, but then it's closed here. So if that was on a 1 minute candle, it would have pushed up, stopped there. That was the highest it could go, but then it pulled back here and closed here. So then, for example, I'm confused a heap of shit. For example, the next candle would open here and then move up or down depending on what kind of market conditions are happening at the time. But yeah, it will, same thing, vice versa. It pushed all the way down, but then it's pushed its way back up, pushed its way back up, pushed its way to the high, and then come back down and stops there. For the bearish candle, same principle. It's opened right here at the top, so it's flipped. It's in reverse. It's opened at the top here. I might have to pause this and start again. It's opened at the top. It's pushed up, so it would have turned into a bullish candle, but then it's pushed all the way back down. It's pushed down to a new low, but then it couldn't sustain that, so it's pushed back, and that's where the candle has closed. So essentially, it's a close. That's the lowest it could get to, and that. Oh, I forget that you can't see my screen. Essentially, it's the lowest point it can get to, and that's the highest point it's got to. So, honestly, as well, message me if you guys do have any questions about any of this. I'll be happy to answer all of it. I want everyone that I'm talking to and teaching to be on the same page and getting up to date as quick as possible. The plan is, to get traders trading profitably as quick as possible. So this is just an example of the different time frames. This is the hourly on GBP USD, and then this is a 5 minute. So it's the same chart. This is the same area, but it's just zoomed in. So it's more of a from an analytical standpoint, it just makes more sense to just zoom into your charts, because then you can gather more information on what's actually really going on within those charts. So normally what most traders do, what I would say all traders do once they've gotten started and they've gotten to a position where they are making money, is that they will use multi-time frame analysis just to confirm a trending bias of the market. It also makes it a bit easier to pick moves and see where the market's going and where it's trending to. Okay, so these are the different types of trends in the market, the different stages within the market. So normally a market will be trending for about 30% of the time, but ranging for the rest. So for that extra 70%, you'll be in a range like this, or like this. Pretty much what those moves do is they gather momentum for the market to move up or move down. So whenever you see a consolidation or a range, that generally means that the market is looking to push either way, up or down. There are the emotions obviously associated with these moves. So this would obviously come after a fear stage. There's a bit of a lack of interest. This is more, I guess, for investing as well, because obviously traders can make money in both these markets. So this would be like a bit of a lack of interest. Ranging markets, not many people like to trade them. They're depending on your time frames. Obviously, you could trade a ranging market in the from the 2 hourly to the 5 minute, because obviously you've got enough range to actually make price movements. But generally, you want to trade with the trend. Trading with the trend's a lot like swimming downstream with the current. You're going with the flow. It makes it a lot easier to make moves, essentially. So first stage, it's a consolidation. It's a bit of a lack of interest. No one really wants to be in. Yeah, it's an accumulation stage. So it's accumulating. It's getting. It's gaining momentum to push up, essentially. Then we get into an excitement and a greed stage. So people are excited, they're making money, the market keeps pushing up. Let's go, let's go, let's go. They're getting greedy, gets to the top, then it's a bit of anxiety. Things slow down. Obviously, this is a demand stage, so demand keeps rising, rising, rising. Yeah, and then it gets to a point where it starts to consolidate again. Is it going to keep going up? Is it going to go down? No one knows. So obviously there's a fair bit of anxiety. In this stage, it's obviously a distribution stage as well, because it's averaging out, it's distributing. The market's not quite sure where it wants to go yet. It's just it's leveling itself out, preparing itself for the next move. And then the last stage is fear. So fear, is it going to keep going down? What's going to be happening? Is it going to be like this forever? This and that. Look, like I said before, traders can make money in both markets. So both of these are what you want. Trending markets make money, essentially. They're the easiest ones to catch moves, to get into. And trade with the trend, pretty much. If you're not trading with the trend, if you're trading ranging markets or you're trying to trade against the trend, it's not a good idea. It's a lot more risky. You're making problems where they don't need to be there, essentially. So just for example, these are some examples of some trend lines. Normally with a trend line, you want to make sure there's at least 3 spots, 3 touches of this trend line. So 1, 2, 3, that would be a valid trend line, or 1, 2, 3. That would be valid until it kind of gets to there. You wouldn't know where it's going, but obviously it's respecting that trend line. It's pushed up, it's come back, it's touched again. So then people might be buying at that kind of level, because obviously it's not breaking, but then once it does break, it still respects the trend line by reversing. It does a pullback, touches it, and then continues down. Same thing here, it's a downtrend. You normally plot the uptrends on the bottom, so on the support, and then the bearish downtrends on the top, so just as resistance. And just finally, we're almost through. I told you it was going to be a little bit of a quick video. These are just some basic structure of a market. So a downtrend, lower lows, lower highs, lower low, lower high, lower low, lower high. Uptrend, high high, lower low, no, higher high, higher low, higher high, higher low. So it just up. These are just some reversal kind of patterns as well. Within the next few videos, we'll start looking at patterns and candles and different candle patterns. But yeah, this is just a double top, double bottom. That's a confirmation that it's retested and retested, broke out. So double top, retest, breakout. And then this is a consolidation. So that's just a ranging market. Ranging markets, like I said, you don't really want to trade because they're just, you don't know where it's going to go, and it might be a lot less volatile. So it's better to just stay out of there. If you were going to trade them, you'd obviously enter in this area or this area and ride it all the way down or ride it up. So yeah, thank you very much, guys. That's it for now. That's the first video. We'll try and get videos coming out every week. But yeah, I hope you learned something new, and I'll see you in the next one.